Today's market move looks simple on the surface. Stocks are down. But when you put all three charts together, the picture becomes much more interesting. SPY is breaking lower, QQQ is getting hit even harder, and at the same time, the 10-year yield is moving higher. That combination tells us this is not just a pullback, it's a repricing of risk. Let's go chart by chart. Let's start with the most important chart today, TNX. On your screen, we can see the 10-year yield trading around 4.28%, pushing higher during the session. This is critical because rates are not falling to save the market. Instead, yields are staying elevated, which tells us three things. First, the bond market is not pricing aggressive rate cuts. Second, uncertainty and term premium are increasing. Third, higher yields continue to pressure equity valuations. When yields rise while stocks fall, it usually means investors are demanding more compensation for risk, not rotating into growth. As long as TNX stays above this zone, stocks remain vulnerable. Now look at SPY. SPY is down close to 2% intraday with a clear lower high, lower low structure. There's no strong bounce. Every attempt higher gets sold. This is not panic selling, but it is consistent selling pressure. What stands out here is market breadth. This is not one sector dragging the index, it's broad-based weakness. SPY breaking lower while yields stay high suggests the market is adjusting expectations. Slower growth, tighter financial conditions, and more headline risk. This type of move often changes short-term behavior. Traders reduce exposure and wait for confirmation. Now let's look at QQQ. QQQ is also down around 1.8 to 2%, and importantly, it's underperforming SPY. That matters. When tech leads lower, it tells us this is not defensive rotation, this is de-risking. Higher yields hit tech twice. Higher discount rates hurt valuations, and crowded positions unwind faster during uncertainty. The QQQ chart shows sharp intraday selling and weak recovery attempts, a sign institutions are lightening exposure, not buying dips aggressively. This aligns perfectly with what we saw on TNX. So what's driving this move? Today's pressure is coming from renewed macro and geopolitical uncertainty, tariff rhetoric resurfacing, concerns around global trade relations, and broader risk-off positioning ahead of major political and economic events. When uncertainty rises, markets don't wait for confirmation. They price it in immediately. That's why we're seeing stocks down, yields staying high, volatility creeping up, and risk assets under pressure.